And we are back. Welcome back. Today what I want to do is talk about problems with statistics in trading. This is the only video that you need to understand probability and statistics in the context of trading. This is not going to teach you all of probability and statistics, but this is going to highlight some of the major issues with the application of probability and statistics at an undergraduate, graduate level in the context of trading some sort of product, whether it be a derivative product, equities, etc. I've been doing a lot of trading recently on my own, and I thought that this would be particularly relevant and interesting. So without further ado, let us head on over to my Jupyter notebook, and we can go ahead and get started. So clearly, we need to model the particular product that we are trading. If we had the underlying density, the structure of the underlying density for the process, there would be literally no reason to develop a model. We would just use that density to derive all of our statistics and probabilities, and all would be well in the world. But instead, we're left with this open-ended issue of modeling the dynamics of some sort of process, whether it be a stock price path or the appropriate value for a derivative product, whatever it is we're trying to model or whatever it is we're trying to price or anything like that. It's a very open-ended question. Now, what I want to do is start with a very fundamental issue in statistics, and that is parameter estimation. And I want to progress down to the idea of stationarity and edge in trading and how all of these things kind of work together. And by the end of this video, you'll have a really nice big picture of how statistics can be used for trading and identifying profitable trading strategies and identifying if your strategy could be profitable, but also the pitfalls that you can run into in implementing your trading strategy. So number one is parameter estimation. So I had said that if we knew the underlying structure of the density or the dynamics of the process, we would have no reason to implement a model. That's pretty fancy. What does that mean? Well, what I'm saying is I'm going to draw a parallel to a coin flip process here. So what I have here is I'm going to flip a coin 10 times, and the parameter for each coin flip, that is the probability of a heads, is going to be 0.5. So each coin flip has a 50% chance of landing on a heads. I'm going to constitute that as a success, and then that's going to be an outcome of 1. If I land on a tails, then I'm going to get a 0. And I'm going to do this 10 times, and what you'll see here is I have a list of the outcomes, and I have 2 heads, and I have 8 tails. Now, clearly this is random. Every time I do 10 coin flips, I'm going to get a different set of results. It's finite, that is, in the context of how many combinations and permutations of heads and tails are there is a finite number of those, but each trial itself of 10 coin flips is going to be random. So parameter estimation is a fundamental problem in statistics, and we have a lot of tools to be able to estimate population parameters. So again, parameter being this 0.5. If we knew what this 0.5 was in the context of the stock market, whether it be some sort of, like I said, derivative product or underlying equity process, regardless, if we knew what the parameter set was in the dynamics, then we wouldn't need to estimate anything. So we don't have that 0.5 in the context of the market. So the best we could do is look at data and try to build a model using that data to parameterize some sort of model. This brings us to problem 1, parameter estimation. We have a lot of tools at our disposal: confidence intervals, simulation, variance reduction. We have a lot of tools. We can use historic data. Whether or not that's appropriate, we'll talk about in problem 2. But here is just one example of an issue with parameter estimation. Well, take a look at this. What if these 10 trials were the only trials that I could observe? I can't repeat this process. Think about it. The previous 10 days of trading only occurs one time. I can't repeat that. So if I take the average number of heads here, I'm going to get 20%. That's going to be my estimated parameter. The particularly keen among us may be talking about variance and confidence intervals and I commend you, but let's go ahead and digress from that notion for now and just take a look at a simple parameter estimation. We have 2 of the 10 flips being heads, so wouldn't it be reasonable if I didn't know what the parameter was? We know the population parameter is 0.5, but if I didn't know, 20% might be a reasonable guess. Okay, that brings us to the first issue of parameter estimation, okay? There is a lot that you can do. Simulation, variance reduction, aiding in tightening the bounds of a confidence interval to provide a more precise estimate as to whether or not that interval contains the parameter. But again, this is a fundamental issue. So that's going to be problem 1. Parameter estimation is how do you determine what that parameter should be? In the context of a trading strategy, you're not just looking at 0.5 as the probability of heads or tails. You're looking at the probability of a winning trade and the probability of a losing trade. It's the same idea as a coin flip, heads and tails. But here, you need to estimate that probability. Do you trade 100 days? Is that enough data to estimate your probability? So hopefully this is starting to become a little bit more apparent as to why this is an issue. You only have so much money to trade with, and more often than not, if you're testing a strategy, you're going to lose it. So what about back testing? Can't you just back test your strategy and then take a look at the probabilities? Well, yes and no. This brings us to problem 2. So problem 1 is parameter estimation. You can either trade live and try to determine your winning probabilities and determine whether or not your strategy is going to be profitable in the long run if you have some sort of edge. Otherwise, you can backtest, but what's the problem with backtesting? That's this idea of stationarity. So what is the issue with this idea of stationarity? Well, in the context of our coin flip experiment, you can take a look at each coin flip as an experiment. You could take a look at each trade as an experiment. The population parameter 0.5 is not going to change. That is a key underlying assumption of our parameter estimation, is that it is not a function of time. If we come down here to the idea of stationarity, let's take a look at what happened here. Well, in the previous 10 coin flips, I've observed 7 heads. So I've estimated the parameter to be 0.7. But the true parameter is actually 0.46. Okay, if we were to reiterate this experiment, let's say another 10 trades go by, or 10 coin flips, you can use either as an example. Here we have a pretty reasonable estimation of the parameter. The true parameter is 0.51, and our estimation was 0.5. But we repeat this again, and we can see, okay, our estimated parameter here is 0.2, but the true parameter is 0.4. And all I'm saying is I'm letting this p-value change with time randomly. So I'm saying the parameter p is a random function of time, which is very reasonable for the dynamics that govern a stock price process or some sort of trading strategy that is a time-dependent function of a stochastic process. And this is the key issue. We're either underestimating or overestimating the probability because the parameter changes over time. When does it change? I have no idea. Is it going to change every 30 minutes, every 20 minutes, every hour, every 10 days? We have no idea. You can backtest all you like, but this is the same reason why historic results are not indicative of future performance. It's because of this key issue with stationarity. We have no idea what the parameter is going to be and when, because if we did, we wouldn't need to try to model anything. We wouldn't need to try to estimate any parameters. So this is the key issue with stationarity. That is, the parameter of the underlying density, or the parameters of the underlying density, or the dynamics of the process are going to change over time. And you'll see a lot of different processes that try to emulate this behavior. And what ends up happening is you have some sort of stochastic term that evolves over time, and that's scaled by some sort of time-dependent function. And you can take a look at things like maybe a local volatility. You could take a look at stochastic volatility that aim to capture that parameterization over time. but it is a very non-trivial task, and of course the dynamics themselves are stochastic, so we have this fundamental issue here. So that's the second problem here. We're going to transition to this idea of edge, but before we do, I want to emphasize that these are not the only issues. These are just some very prevalent issues in applying basic statistics to the idea of trading. You could have violations of independence. You could have a violation of the density assumption that you're assuming your returns are distributed as. You could say that they're normally distributed or log normally distributed, when in reality they have excess kurtosis and they're leptokurtic and all the moments don't match, and you have all of these different issues. There's volatility clusters, leverage effect, so on and so forth. So there are a variety of issues baked into the actual empirics of the financial markets, but for now let's just take a look at these in the context of a simple trading strategy and see why we have an issue with parameter estimation and stationarity by looking at a trading strategy. So what is edge? Let's start with this idea of edge. I think in simple terms we can just say edge is the idea that if you were to reiterate this experiment, whether it be playing roulette or trading a particular strategy, in the long run you're going to make money. And that can constitute what's known as a positive drift. In other words, supposing that you don't go bankrupt first, which is more of like a gambler's fallacy sort of problem, you will make money in the long run, assuming this expectation is strictly positive and is going to maintain its positive nature over time. Key word, maintain positive nature over time. Okay? Let's break down this expectation here and talk about the implications. So for any trading strategy S, we could say that that's buy on close, sell on open, buy on open, sell on close, buy on open, sell midday, buy when there's an imbalance, sell when there's momentum, whatever it may be. We can define a trading strategy S, and the expected P&L will always be as follows. The expectation of S is equal to the expected P&L when you win times the probability of a win plus the expected P&L when you lose times the probability you lose. And that is going to be the same as the unconditional average of your overall P&L. But this is going to give you more information. Why? Because it tells you how your win and loss ratio plays into your overall trading edge, your expectation of your P&L over time. Okay, but what are these values? Clearly, we do not know. We can get these values one of two ways. We can backtest. Obviously, there's a whole set of issues with backtesting. You can have look-ahead bias, you can fit a curve, you can do 10,001 things wrong in estimating these probabilities, even more issues and bias than I've already discussed, or you could trade live. You could trade live with your own money and then try to estimate these probabilities. So this takes us to that first issue of parameter estimation. How much is enough? What is a reasonable amount of data to use? And when do you change these values? Maybe you change them on a rolling basis every week, maybe every 2 weeks, so on and so forth. It's important to keep that in mind, is they are not stationary. So these two issues immediately play into the expected P&L of our trading strategy. So what do? Well, I'm going to take data that I have here from trades, and I'm going to compute the expectation of my trading strategy, the expected P&L. So here's my data. I have P&L of 150, 120, 90, 100, minus 300, minus 100, and minus 50. I have 4 wins and 3 losses. So what can I do? Well, I can derive each piece of this equation and then glue it together to get the overall expectation. So the expected P&L when I win is 115. The expected P&L when I lose is minus 150. The probability of a win is 0.57, roughly. And the probability of a loss, this should be a loss, is 0.43, roughly. So when I multiply the probability of a win times the expected P&L of a win plus the probability of a loss times the expected P&L of a loss, then I'm going to get the overall expected P&L. And that's exactly what this equation here is telling us. It's saying if I take the average winner multiplied by the probability of winning plus the average loser times the probability of losing. Then I get the unconditional average P&L. Okay, this is great. So my unconditional average P&L is 1.42. What I'm going to do is I'm actually going to simulate this trading strategy over time. So here, I'm going to simulate it for 252 days. I'm going to assume that on each day, I'm either going to have a win or a loss according to this estimated parameter set here. And after a year of trading, this is my outcome. Well, that's not good. I'm down 3,000 bucks. That's terrible. Well, if I rerun this, look, I'm up $750. So where's my edge? Why am I not seeing my edge? Well, if I keep running this, I'm going to get different charts. It's stochastic. But if I increase the days to, say, 2,000, now we're starting to see some drift. If I make it 100,000, now we're starting to see some drift. If I make this 1,000,000, now we're starting to see what I mean by this drift, right? We're seeing this edge. That's exactly what we have here, is even though it's stochastic, we have this edge. We're going to have losses. We may have big losses. We're going to have wins. We may have big wins. Over time, everything's going to average out such that we will generate money over time. We will be profitable in the long run. You just have to survive the short run. Here we survive the short run. Here we survive the short run. Here we do as well. Here, maybe we would have gone bankrupt first. Again, more of a gambler's fallacy problem from a stochastic processes class, but you catch my drift, pun intended. So what we have here is we have the equity curve of our strategy, and we can see that edge over time. As I increase the number of time steps, we get this curve going up and to the right. That is our income over time. That's what we want to see from a trading strategy, okay? But very easily, these parameters, just as we saw up here in the context of stationarity and parameter estimation, they could be wrong, first of all. There's no reason why the probability of a win should be 0.57 and the probability of a loss should be 0.43. What if in reality we estimated wrong? We estimated the coin flip wrong here. We said 20%. So why is this enough data to estimate the probability of a win, right? If I run this equity curve, look at that. That's terrible. That is terrible. What if we don't include transaction costs? This could be even worse, okay? So in the context of parameter estimation and stationarity, there's no reason for this curve to maintain the same parameter set, or the parameter set that we've estimated in the first place is already wrong. So those are two potential issues in this idea here, okay? Why is the law of total expectation helpful? Well, if you keep reevaluating this on a weekly basis, maybe you stay current, maybe every 30 days, so it's completely arbitrary. You can determine whether or not you're gaining, losing edge, or you can take a look at your edge over time and even plot that and see if in the long run you will have a reasonable strategy that is capable of generating money. So what I have here is a little app. I mean, I could barely call this an app, I would say. But if I change this slider, I'm going to compute the edge of the trading strategy S. So this is my win probability here. And you'll notice that the loss probability is just going to be the complement, 1 minus whatever this value is. So if I make the win probability lower, let's take a look at what happens to my edge. Goes away, minus 70. Well, that makes sense, right? Because the probability of a loss is much greater than the probability of a win, and the expected value of a loss is much greater than a win. So this is a terrible strategy. This is a terrible strategy. But if my win percentage is like 80, then let's take a look at my edge. 67.299. That's fantastic here. That's fantastic. Let's take a look at the equity curve under this condition. Look at that. That's 1 year. If I have 80% wins, and my win expectation, my average winner is 115 bucks and my average loser is 150, that's my equity curve trading that for a year, assuming that I can get one trade in a day. But what if my win is 10 bucks and my loss is 150? Yeah, I have an 80% win rate, But what's my edge? Minus 17. What's my equity curve look like? That's a terrible equity curve. That is a terrible, terrible equity curve. So this is just something to keep in mind that, when you are trading a particular strategy, these things are objective. These things exist whether you like it or not. You have a win probability that is a time-dependent stochastic function, and you also have a expectation and you have a win expectation and a loss expectation. That is the average winner, your average winning trade, and your average loser, your average losing trade. Whether you like it or not, those things are present and they're always evolving through time. So you're going to have to do your best to estimate these values. There's a lot of different techniques in the literature. I'm not saying these are impossible problems to solve, but they are problems that you are going to have to deal with. You have to determine whether or not you're using enough data to estimate your parameters. Are you using too much old data? Should you weight new data more? How are you looking at your average winner and loser? Has there been a regime change? Is it different post-COVID? Is there a new regulation that impacted your over? So do you see how there's so much that goes into determining the actual parameters associated with the trading strategy? Trading strategies don't always work. Sometimes they work for a couple years, then they stop working. You just got to survive a bonus cycle or two, and you'll get rich, and then you'll get fired, or the firm will go bankrupt, So these are kind of the ideas that I wanted to cover in today's video to shed some light on what's actually going on in trading. It's not that necessarily people know more than other people, or they have some sort of magic crystal ball, unless they're insider trading, which is always going to happen anyway. But in the context of edge, this is exactly what it means. Is like, look at this. We have negative edge. Over time we're just losing money. Versus here, if the loss is only 27 bucks, what kind of edge do we have? $5 of edge? That's a great equity curve. So I hope you found this video informative, if nothing else, maybe slightly entertaining. But these are practical statistical tools you can add to your toolbox right now to evaluate how you're trading. You can take a look at your expected loss, expected win, look at the probability and see, hey, like, you have a negative edge over time, you're just going to keep losing money, or you're going to keep making money, maybe, depending on how the parameters evolve over time. So I'm going to put a link to this Jupyter notebook in the description box below. If you'd like to check it out, I'll post it on my GitHub. And you can play around with these charts. If you have any questions, you can leave them in the comment section, join the Discord. Tend to be a little more responsive there. But I hope you've enjoyed this video talking about some problems with statistics in trading. And I will see you in the next one. If you'd like to see more content like this, please let me know. Other than that, thanks for watching.